Yeah.
Okey-doke. Well, militant timing. Let's kick off as we intend to go on. So, welcome everyone to the afternoon session, and thanks for joining us. We're going to be talking about navigating the journey, decarbonisation and sustainable finance. So, hopefully, over the next hour, you're going to have some good insight and experiences to take away and hopefully leverage for your own actions and implementation. To kick off, I'm going to introduce myself and then our panellists. But my name is Charlie Brunyate. I'm the co-founder of Mineral, a sustainability and corporate communications agency focused on ESG and change management. We aim to support businesses with their sustainability strategy, comms, engagement with their wider stakeholders, and help businesses sort of plan, implement and deliver sustainable change and performance improvement. So that's looking at sectors across sort of real estate, renewable energy and finance, which is why I get the privilege of sitting here today. Beyond that, I'd like to introduce our panellists, and I'll start in the order we're all sat. So I'll hand over to Beverley. Say hello.
Hello, I'm Beverley Gower-Jones. I'm managing partner of the Clean Growth Fund, which is a £100 million venture capital fund investing in Series A companies in the UK that have the ability to significantly reduce greenhouse gas emissions.
Hi, good afternoon everyone. My name is Stanley Kwong, Head of Sustainable Investment for KKR in Europe. For those of you who don't know, KKR is a global alternative investment manager with around 550 billion assets under management globally. A lot of our investments go into climate as well as sustainability focused companies, so I'll talk a bit about that later. Good to meet you all.
Hi everyone, I'm Emily Norling, Impact Director at Summa Equity, a Nordics-based private equity firm that was founded in 2016 with the purpose of investing to solve global challenges, including climate change. We have around 5 billion euros under management.
Thanks. Hi everyone, I'm Ella Sexton. I'm a Senior Manager at the Institutional Investors Group on Climate Change. We're an investor membership organisation with over 400 members representing about 65 trillion combined AUM in dollars. And we are also the owners of the Net Zero Investment Framework.
Hi, and I'm Hugo Kimber. I'm the CEO of Carbon Responsible. We're a leading carbon accounting firm delivering an audit quality output for our clients. We've been doing this since 2012. We work for a very wide range of clients, helping them to measure, to reduce, decarbonise, and that's both at an investment level and an investment managers, asset managers, at portfolio and at asset level. We are working then to ensure that our clients really have a very good base from which to set off on a decarbonisation pathway. That's essentially the work we do, and look forward to discussing some of it today.
Thank you all. Appreciate that. So yeah, I think when we look at investment and pensions, traditionally that's very much focused on risk and sustainable returns over the longer term. When we add sustainability into the mix, we're considering sort of the new trending topics, sort of biodiversity loss, climate risk management, and today's topic, decarbonisation. And to achieve this, it requires a big blend of public and private finance. So I think as we go through today, we want to progress from what it is, what the themes and issues are that we're looking at and dealing with, and then also some practical application as to how we can do that and our experiences of it. So I think to kick off, Stanley, could I ask you just to give a background on private markets and a brief introduction on that?
Yeah, sure. So unlike public markets, we invest in companies which are not listed. A lot of our strategy traditionally is to support the company through a value creation lens. And that's not necessarily sustainability, but when you add a sustainability-focused approach, you can apply the same logic. You can help the company grow, you can help the company decarbonize. At KKR, we've identified a few cross-portfolio themes on sustainability, which we help all our companies drive through. So on day one, as soon as we onboard a company, we're helping that company understand its ESG journey, mature its ESG resourcing, and decarbonize if we're focusing particularly on climate change. There's a business case for this as well. It's not just that it's just an objective of ours. In Europe in particular, there's regulatory trends and there's regulatory tailwinds which support the need to decarbonize companies. So when we look at the companies which we invest in, a lot of them don't have this capability up front. So it's really critical that we bring in the resources and bring in the learnings which we have from more mature companies and help them, baseline their emissions, set science-based targets if it's appropriate, look at the decarbonisation initiatives which they should do, the levers which they should pull, and actually accelerate their decarbonisation journey with the end goal of when we exit the company, we view that there's going to be an exit premium. And if we don't, there could be a discount to the company. So there's a business case to what we're doing, and I think the private markets model really leverages on that existing governance structure and value creation mentality to help the companies do it. And we have a specific team which helps the companies handhold them on this journey and make sure that they're geared up to understand the various challenges which decarbonisation warrants. Decarbonisation is not an easy journey, so we may start from educating the company and the management of the board all the way to linking it to financial incentives if it's required.
Thank you. I think you've touched on some key topics there to kick off our first part of the conversation around the what of investment and pensions and wealth management. And I guess you mentioned sort of some of the drivers there around regulation and so on, but things like technology, innovation, they're all key things and aspects that we need to finance and fund to drive decarbonisation. But I guess a question for all of you guys would be, what are you seeing and what is the context around the latest investment strategies and your thoughts on those particular drivers?
I think fundamentally, when we look at helping companies on their decarbonisation journey, ultimately the thing that they all really need is new technology solutions. So decarbonised technology solutions that allow them to still carry out their core businesses but with less carbon impact. And what we see with a large number of funds and so on, particularly in the listed space, is a lot of engagement, a lot of encouragement, frameworks and so on to go down that decarbonisation journey. But as those large corporates start to take those steps, they're going to find that the technology they need isn't there because there isn't enough investment going into new technology innovation to decarbonise all the things that all corporates use: paper, steel, ceramics, glass, cement. All those hard-to-abate sectors need new technology solutions, new ways of manufacturing and creating those materials which we all rely on, and that's absolutely fundamental. So something like 40% of the technology that we need to get to net zero, we don't have yet. And so there's a massive requirement to start not just to talk to companies and engage the listed companies in their journeys, their action plans, but actually to square the circle, to invest in the fund managers and in the technology innovation so that it's going to be there to implement in the supply chains when these large corporates need it.
Thanks, Beverley. Anyone else got anything to add to that?
I agree and I disagree to a certain extent. So what we do, we have 3 investment themes: resource efficiency, changing demographics, and tech-enabled transformation. And if we look at resource efficiency, which is a theme that we've been focusing on a lot over the past years, we did a quite significant piece of research into the system that is within waste management and circularity. And what we saw was actually what you say, stuff that we use, so paper, cement, glass, everything. It's 1/3 of global emissions, 22% of Europe's emissions. And if we looked at the technology that we have available today, so not something that we see in the future, but things that we already have, we could actually, if we invest the money, so the technology is there, it's just that we need to make the business case to invest the money. And we saw that with 230 billion euros of investment, and it's a lot, but it's also not huge. If you look at the GDP of Europe, you would actually unleash a 1.5 trillion investment opportunity, which is in the private equity space a great investment opportunity. So I think we also need to look within certain sectors where we actually can start moving. Yes, there are definitely challenges in certain industries, but we also shouldn't focus too much on the difficulties, but also just get going and doing some of those investments that we see and that we can do, even if the perfect data and the perfect technology is not there. There's still a lot that we can do now.
Yeah, I think maybe just to add to that, I think a bigger trend recently is really investors seeing the value in both sides of the coin. So decarbonisation of existing assets, but also in investing in climate solutions, as was just mentioned. And I think that second part of the coin has maybe been undervalued previously, particularly given a lot of the conversation around decarbonisation in financial services came out of financial risk, and we were just talking about this before the panel, how actually it's only recently that you're really seeing that opportunity side of the coin come more into focus. And so definitely that trend of investing more on the climate solutions side is one that we're seeing. I would just add one extra one in there in terms of we work with a lot of universal owners or big pension funds, and they also have this slightly more global view in terms of the money that they're investing. And we're really seeing this developed versus emerging markets dynamic coming into play now as well. And I think there's a recognition that actually a lot of the investment for the transition needs to come in emerging markets. And traditionally, a lot of kind of climate investing the capital hasn't been directed in that area, and it brings a slightly different approach and different challenges. So that's the second theme I'd say we're seeing.
Thanks. I'd also like to just pick up on the resource efficiency piece. In the work that we do with clients, some of that is obviously in things like sustainable infrastructure, so in technology areas, but there's a very large amount of work in understanding what impact is and then starting to push forward efficiencies within the sectors that people are in. So that could be data centers, for example, where we see there is a commercial imperative to be able to actually drive down the impact of data center usage, which we all need. That comes from an understanding of what the impact is in the first place, which is part of where we come in. But I think it's essential that we are trying to do all of these things in tandem a bit in the way that you're suggesting it as an investment strategy. It won't all be about technology. It will be about resource efficiency. It will be about moving the dial in things that we do now and will continue to do for quite some time during the transition and just making that more efficient.
Thank you. I think you guys you've touched on some really sort of insightful points around some big hitting topics that we currently cover today: the emerging markets, resource efficiency. They all interconnect with other key sustainability issues. And Beverley touched on engagement at the top of this piece. But given all the topics you guys have mentioned, do you feel that there is a need for greater engagement on particular interest, knowing that we can't please everyone with everything we do, and the fact there is so much noise around sustainability that there needs that clarity? So is it better to niche your focus on one particular thing, or have a broad brush spectrum to try and achieve more? What's your opinion?
I think where we're at the stage of the game, we need a broad approach, but it needs to have 100% focus in each of the different topic areas. So we need to decarbonise at the lowest possible cost. One of the things that's often overlooked is the cost per tonne of decarbonising. And so when I look at amine technology for carbon capture, for example, the cost per tonne is far too costly. So yes, the technology kind of exists, but it doesn't really, because we can't implement it commercially. And so what other innovative solutions are there out there to enable that to really happen? And that's an absolutely key technology that we need to get to net zero by 2030. And we need to do everything we can to kind of accelerate that and find new technology solutions and move that along. And so that's, kind of one perspective on kind of key technology that's required. But of course, there are multifaceted, angles to this. Just to move one thing along 100% of the way, the ecosystem is a complex adaptive system, and so everything actually needs to move for those things to be in place. So we need equal focus on the regulatory and the standards, for example, to enable the planning and electricity connection to the grid that's going to be required to get to net zero. Equally we need supply chains to decarbonise, which means that corporates are going to have to collaborate in particular sectors because they all use a similar supply chain, and to have 10 large corporates asking each supplier to do something differently is just not going to work. It's going to be far too expensive and far too resource intensive. So collaboration among key industries, such as pharmaceuticals, for example, is absolutely critical if we're going to, actually get to this journey. So there's a couple of large themes to kick off.
Yeah, absolutely. Thank you. Anybody else have anything to add to that?
I would say ultimately it's a materiality-based approach which we have to take, because there's so many different sustainability topics which can affect a company. But frameworks do exist which say this particular ESG issue or sustainability issue is at the highest risk and highest materiality for this type of company, right? So we need to focus our efforts on those particular topics so that we're driving the right CapEx and OpEx focus or resource into those areas. And there's a financial case for this too, because when we sell the company, whoever's looking at it would look at the same metric. So that's quite critical. And we're also trying to front run what metrics will exist in a few years' time. So there is regulation coming down, and there's data platforms, etc., which build transparency around these sustainability KPIs. And when that happens and the playing field is leveled, you'll be able to compare this company to that company, even in the private markets. And that will create competitive tension. And we want to be in front of that, so that if we're invested in a company which is a carbon-intensive sector, we need to decarbonize. And we need to decarbonize with an investment-grade gold standard decarbonization plan, not just a random net zero plan which can easily be have holes poked through. So that's the kind of the imperative of why we need to look at certain metrics and not kind of try to boil the ocean of looking at everything. And it's also important that when we think about how that links into the financial structure and the commercial case of it, we can start to tie in these metrics into sustainability-linked financing or sustainability-linked incentives of the management, so that there's an incentive structure around this on a few particular sustainability KPIs to make sure that the company delivers what we tell them to do. So it's important sometimes to recognize that not everyone has the same mentality of needing to drive focused decarbonization as sustainability investors or sustainability-focused investors. So these incentives really kind of lock in very specific, bonus remuneration packages to the delivery of decarbonization metrics.
I think it's also very important when we talk about decarbonization that you understand the system which you operate. So, who are you as a player? What can you do within that system? And what we try to do, or what we do for all our investments within our sub-themes, and we've actually gone from quite broad themes that I mentioned before to focusing more on specific sub-themes, because we find that you actually need quite a lot of industry expertise to understand what measures you put in place, what effects they have, because it's not just about reducing carbon, scope 1 and 2 emissions, if you like. It's also about understanding the value chain and what implication it has down the supply chain. So, if you're looking at carbon only GHG emissions, then maybe you want to invest in biofuels that get their feedstock from Brazil and ship them to Sweden to make that biofuel. But obviously, if you take the full value chain into account, that's not the best solution. So I think understanding the system in which your companies operate in is very important. We use the theory of change framework for all our sub-themes. So for resource efficiency, we go through, what is the impact that we want to have within this space? And what outcomes are actually supporting that impact? And then we set specific output KPIs that we link to the company's core business that actually drive the change. And that becomes super important to make sure that through our decarbonization journey that we don't create more severe problems than the ones that we're trying to solve for, which is, not just related to carbon, but also other sustainability or environmental issues.
Thanks. Thanks. Yeah, I would agree with that completely. I mean, I think I've always been a proponent of, particularly with the nature or climate debate, like you need both at the same time, because otherwise you end up harming one for the other. I was just going to say, I actually think this issue of needing to be broad but also needing to be niche is one where investors can be really powerful because the system already operates on that basis. You've got really kind of specialized small funds that have expertise in those real like thematic issues, and as you say, you need that expertise. You can't really be a generalist if you're looking at that kind of niche level technology, but you also need to make sure that top down globally we're allocating money to the things that really matter. And to Stanley's point around materiality, we know there are just a few specific activities and technologies that are going to drive the majority of this change. And it's really important that we make sure that we are channeling proportionally the right amount of capital to where the gaps are, to create that kind of like global transition as opposed to just transitioning a few niche sectors. And I think that's where asset owners can really come into play by looking at kind of the funds they're allocating across the board. But they really do need that partnership from small funds that have that expertise on where the money is needed, which technologies, and how to bring them to scale.
Yes, I think certainly focusing on what you know and using the commercial and technological experience that you have within any sector is important. We work for some portfolios that are very specifically focused in, for example, data infrastructure or broad spectrum clients who may have assets in everything from renewable energy right the way through to real estate and public equity. There are lots of things to be focusing on, but to Stanley's point, and one that Ella's echoed, is that you have to start by looking at what your impact is, but critically the materiality of that impact. So where are the most material impacts? Also, do you have influence over them or do you have control over them? These things help to guide you in the right direction to be able to see where the areas of most important focus should be. And once you start to look at those areas you focus on a more narrow range initially, or using a kind of thematic and sector-specific skill you've got, you can then start to build up a program that becomes quite credible. Some of it will be supported by technology, some of it by resource efficiency, but you have to not try and boil the ocean from the word go. That sometimes is the approach, that people will look at so many different Scope 3 categories, for example, all 15 of them, and go, well, that's a lot, I must do something in everything. That is the sort of approach that would just take decades to come to fruition, and we need to focus where we think the biggest impacts are and where we can control them.
Thank you. A lot to digest there, I think. Some of those topics and comments, they kind of resonate at a general sustainability level. So for me, looking at the what, as we've just discussed, a lot of it aligns to sustainability and transfers to other industries, transfers to energy markets, real estate, and so on. So I think there's a lot of transferable information we can all take away from that. In terms of, Ella, you mentioned sort of this is how things operate currently. I think a lot of this with sustainable finance opportunities stems for reframing. It's how can we take the traditional ways of doing things and then apply them to a new product or a new fund or a new service within finance. So if we have the what from this first part of the conversation, I'd like to move over to the how. How do we apply that to those climate solutions, adaptation, mitigation opportunities, and other innovations that perhaps are still to come? So, next question for the panel. How do we go about creating these products of the future from a financial perspective, and what are your experiences? I think maybe we'll start at the other end with Hugo again.
Okay, so I think if we're looking at how we might approach something where we're trying to get to a point of reasonable outcome, what we're saying is that what I've already said, I think, is resource efficiency. I think is an important part of this, but beyond that, it's more about both a technology view but also an investment and return view. So if you're going to take an approach, there has to be some kind of economic value that sits within that. That has to be behind the approach that underlies how you go forward on that.
Yeah, just to add to that, maybe and bring like a bit of a practical lens to this question. So I think there's a bit of a misconception around what influence investors actually have over decarbonisation and how they can actually affect change in the real world. You hear a lot of talk around divestment and not investing in, misaligned activities. But in reality, that's actually been shown by research to be one of the least effective ways to drive real world change. Because if you're just getting rid of assets, then they become someone else's assets. And so in reality, I think there's, we've kind of distilled it a little bit. There's only 3 or 4 ways that investors can really affect change. One is providing new capital. And that particularly speaks to the climate solutions conversation that some of the other panelists were mentioning earlier, that new capital to the right technologies is really, really important. The second one is by influencing cost of capital, as I just mentioned. But that's been shown to be a bit less effective, so it really needs to be combined with some of these other strategies. Third one being engagement with existing assets. So, having those conversations, different types of assets, obviously, and different types of investors will have a closer or a weaker relationship in terms of how effective that engagement can be, but it's a really powerful tool, particularly across the listed space. And the fourth one being engaged with the ecosystem around them. So we've really seen particularly policy engagement as a really kind of important lever, and that's really built into the work that we do here is, being able to engage not just with assets in your portfolio, but also with the wider ecosystem. And I think for me that's kind of the 4 things that I'd say are really how investors can actually affect change in these areas.
Yeah, and I think following up on that it's important that you recognize who you are as an actor. I used to work for an insurance company, and there it was very much about that. I have only limited capabilities of doing things, which is why I find the private equity space very interesting from a sustainability perspective, because we actually go in with new capital to the companies. We also own a majority of the company, so we can actually steer very clearly what the direction of the company needs to be. And 2 practical things that we do is, first of all, we require all our companies to do proper carbon accounting and set science-based targets. And we see that companies, we're pushing them, but their customers are also pushing them to do this. So they actually see this as more and more as an opportunity, and they're missing contracts or tenders if they don't have these things in place. So it's sort of becoming a fundamental to have just those basics in place. But another thing that we find, and I'm coming back to that waste management, because that's something that we spend a lot of time on. We have a waste management company called NG, and when we acquired the company, their income stream came from collecting waste. So that was how they made their money. Now they've been doing a lot of work, collaborative work with hospitals and others to be able to collect waste in a way that they can also provide downstream income from their operations. And there it becomes really a win-win situation. And I said before, 22% of emissions in Europe come from stuff. So if we can recycle it, and if we start getting into the idea of, raw material is not as cheap as we think it is, because the planet is actually taking a cost for that, and just getting to the mode of actually using the resources that we have more efficiently in the system. And if we invest those 230 billion that I talked about before, we're going to be able to reduce 55% of Europe's emissions, and we're going to be 80% self-sufficient in terms of resources. So it's really a great opportunity to understand how we manage the resources that are already in the system, and that's also going to help the decarbonisation.
I think the private markets model, as you just mentioned, lends itself quite well. It's a very active ownership strategy, and you can apply the same logic when it comes to decarbonisation. A lot of my time is to work with the portfolio companies itself and work with the heads of sustainability with the companies to make sure, as you mentioned, emissions baselining, setting appropriate decarbonisation targets, bring in consultants which have expertise in a particular sector to help do all of this. But I would say that in Europe in particular, this is becoming nearly basic hygiene, I think. When we onboard companies, we expect them to do this. It's a key criteria for our investment, and it's important that the company does this within 2 years. I think what we're heading towards in the next few years is an implementation reality check on some of this, because relatively more easy to set the target than actually implementing it. And I think some of our companies in the coming years are going to go through more challenges around balancing how to meet these targets, weighing it up with the CapEx and OpEx requirements, what type of consultants they should use, what type of supply engagement strategies they should have to actually achieve this. So I think this is going to become more challenging, but the sophistication of the discussion is actually going up as well. And if a company does not have a sustainability resource, it would be up for us to help them build that as well. So there's a really hands-on strategy here to actually help the company do it. But it's by no means an easy thing to do. And I think it's important that we help the companies navigate as well as possible when we face these challenges.
It's interesting that you say that, because we were talking about it a little bit early before the panel, that we see actually a shift, that it seems to be, because our portfolio companies are actually very keen on knowing exactly what it means to set targets. They're not at all keen to get into a situation where they don't know what CapEx will be required, what OpEx will be required. So they actually want to have that work done before, which I think is different from just 3-4 years ago, where everyone was on this target setting journey and everyone just wanted to get on board because it felt good, but now they realize that it maybe wasn't so easy. So I think a lot of lessons have been learned, and that we have actually, a lot of companies have matured on that topic, and they want to know before setting targets what it actually means.
So I think my perspective on this is that, and it's been mentioned earlier by Ella, is that to successfully invest in the right technology solutions that we need, you need really deep expertise, specialist expertise in that particular area. And so the fund of fund managers and the pension funds and so on, who are all very resource constrained, need to actually start to spend the time to evaluate, and the specialist small fund managers, who are the ones that really know and understand the technologies and can really back and invest in the right things. So we actually need a shift in the size of the teams and the expertise and ability in our institutional investors, so that they have the bandwidth and they have the capability to be able to assess fund managers and then invest in the right ones. We're not going to decarbonise the planet based on software and SaaS and apps, right? We need hardware, we need engineering. And therein lies a huge problem, because we can invest in these companies as a venture capital type firm up to the Series A, maybe Series B type stage. But when they need the 40-50 million pounds to build that first commercial demonstrator, where do they get it from? The project and the infrastructure finance, they're not there yet. There's still far too much risk left in the system, so they're not going to get the funding from there. The growth stage venture capital firms are all saying, well, we need revenue certainty, so we're not going to get the money from there. And the angel and the crowdfunding and the smaller VCs don't have the deep enough pockets to be able to do that. So we need new products, we need new finance tools, right? We need a way whereby a strategic investor can invest alongside the government and alongside a private equity investor to build that £50 million plant, to be able to show that it really will deliver on its promises. We need funds that have hybrid structures, so you can put venture capital into Topco and you can put project finance into the SPV underneath. So you're not constantly playing this game of, well, I don't want to put the venture in because I don't know if the debt funding is going to come. I don't want to put the debt funding in because I don't know if Topco is going to go bust. Yeah, so we need new finance tools to enable us to do all those things, and we need them, now and very quickly. And so one of my hopes is that with the Mansion House reform, we can start to look at not putting all our pension fund money in the UK offshore into listed funds and assets, but that we can start to look at how do we repurpose that money, how do we put that into unlisted fund managers in the UK that can help grow the UK GDP in the sustainable areas that we know are absolutely fundamental to economic prosperity.
Thank you. Yeah, insightful. I think that, again, a lot to unpick with all of that. But, I think the undercurrent for all those things from my point of view is it requires change to be able to get to this state where we can invest in the solutions of the future and drive decarbonisation. And on a daily basis with clients on my side, change is something I look at. And one of the things as part of that is education. The topics that have been discussed and the points that have been made are all underpinned firstly by data and hopefully science-backed data at that, but the education around it, what are we looking at, what are we looking for, how do we find it, how do we then implement it, how do we create these opportunities, and how do we reframe our thinking around risk. And we've touched on it before, but finance is obviously very much a risk-based activity. So from a point of finance, wealth management, pensions, and again, ESG, what are your guys' views on the changing shift in mindset and thinking around environmental and societal risks?
I think it's a real conundrum that hasn't been shifted. I often hear that investors in Europe don't have risk appetite compared to those in the US, and I think the bottom end of that is that they price that risk differently, and partly that's because of the size of the market and the size of the amount of capital that's available. So here in Europe we often exit our investments much sooner and get that return back rather than let those things grow and flourish. And I think if we're going to be successful in this, we actually need to be able to hold those investments for longer and give them that opportunity to grow alongside doing the right things for society in terms of enabling jobs and job creation in those local geographies. So maybe rather than having one fund that covers multiple geographies, what we should be doing is partnering up with governments per country and actually creating funds that are specific to a specific country, because each country wants to grow its own GDP from its own innovation. And when we have a fund manager that says, well, I do everything, you don't enable that to happen. And there are lots of pension funds like Royal Mail or the BBC and so on, which are country specific, and that's true in every single geography. And I think we miss a trick by not engaging those in a country way, so that we can have the lens from government to look at what a particular investment needs to achieve in that particular geography, and therefore the employment and so on that goes along with that.
If you look at the real estate sector, I think this is a very interesting kind of asset class where I would argue that there's much more maturity in the ESG metrics which are out there, ESG benchmarks which are out there, particularly in Europe. In the past 6 years, that's come into play. Most of the European real estate funds would have to, in some way, measure this for a portfolio. And there's a lot of transparency around if you're buying a particular office or residential building, you can quickly see whether that asset will be stranded or not, and in what year. And over time, that has actually influenced the market and how pricing works. So when the metrics are there and the benchmarks are there and everyone can see what needs to be done for a particular building, that's when the pricing starts to come in. And you can see that mostly in the real estate sector. It becomes more difficult when you go into private equity or infrastructure, where the sectors are quite varied and the type of ESG KPIs which you look at are very varied, right, for each sector. So that's where the materiality aspect comes in. But if you look at the direction of travel, these metrics will become consistent in the next few years. There's regulation pushing that behind in the European Commission or on specific frameworks which they need to measure towards. So my hope is that actually in the next few years, that's what happened in the real estate sector will happen in other sectors, and that will start to bring in some financial pricing to some of these metrics, and then the market will dictate what happens from then on.
I think the time perspective is also very interesting here, because quarterly reports, quarterly financial reports that you're chasing if you're a public market company, some of those investments are not going to pay off in a quarter, right? So you need to have a bit of a long-term perspective, and that's why I also think the private equity model has a responsibility to do certain things within this space, because we do have a 5-year ownership horizon, and then we need to think about the next owner who's going to think about the next owner, so at least a 10-15 year time perspective, and within that time frame there's quite a lot of things you can do and build your value creation story based on decarbonisation or what it may be, but it gives you that time, and I think that's an important aspect that has gotten lost a little bit from the 1987 Brundtland Commission definition of sustainable development, which was about economic, social, and environmental, but it also had that intergenerational aspect of it, the time horizon and the responsibility that we have towards future generations, and trying to have a bit more of a long-term perspective to things.
Thanks. Yeah, I'll just. I think the only point I'd have to add is on a kind of more practical level, I guess. How do you get people internally in companies or in investors to educate themselves, not on the side of their desk? So I think for a lot of people, a lot of employees that have a sustainability objective as part of their job are interested in this topic, may know about it, may have studied it, but there isn't a really kind of mature way at the moment in many companies of flowing down actual responsibility for delivering those objectives into the jobs of the people that are meant to deliver them. Too often it's a kind of additional responsibility on top of your already full-time job, and particularly we see this with sustainability reporting, which I'm sure anyone that works in the space has felt the kind of burden of that in recent years, and these are kind of responsibilities that are being piled on top of people who don't necessarily have the time to educate themselves about what is an incredibly complex topic and take the time to do it properly. So I think for me, that educational piece is really important, but it also needs to come with proper resourcing and allocation of the right number of people to deliver the task at hand.
Yes, I would say that in terms of what we've seen over a 12-year span, there's definitely been an improvement in awareness and understanding. There's always the risk, given what we do, that this is entirely climate-centric, when there are other impacts that we need to be considering along the way. However, when we start to look at that awareness, it's supported also by greater disclosure by all sorts of entities in terms of what their impact actually is, and people being able to see that as part of a bigger picture in terms of what might be happening nationally or internationally, or trying to keep temperatures to a 1.5 degree rise. So we're seeing that. I would like to, I'm cautiously optimistic, Stanley, that it will be in the next few years that we will start to get more harmonization around these metrics. Right now, we do not have the harmonization we would obviously like for those people who spend a lot of time in the detail of the accounting and the data. I don't think that should be stopping us or retarding action at all. But when we're trying to compare different assets, people are trying to work out what good looks like for them. It's more difficult at the moment because the data isn't as uniform as it needs to be, so that makes things quite complicated. But mercifully, we are moving at a pace where greater data, greater understanding of what decarbonisation means and science-based targets means that we are actually driving more awareness and more change along the way.
Thank you. So what does good look like? It's a good point, Hugo. We've established we've covered some of the how and the what around these opportunities. I guess now comes the fun bit about the application. So I want to speak to our panelists about how they've actually experienced this in reality. What does this look like? How is it manifested? What are we actually seeing on a day-to-day basis? So guys, in terms of what you've experienced, what have been your challenges and what are the barriers that you have to overcome, both now and forward-looking?
So I guess one of the biggest challenges was raising Clean Growth Fund number 1. As somebody with over 20 years experience helping low-carbon entrepreneurs commercialize technology, the track record in investing, it was felt that it would be easy just to understand 20 years worth of climate experience, but much harder to pick up the process of venture capital investing. And so raising Fund 1, which is £100 million, through the pension funds and institutional investors was a long, hard journey. And actually, it's way, way harder to understand the barriers to commercialization of climate tech than it is to understand the process of VC investing. And that's not to say that VC process is easy, not at all, but there are transferable skills. It is a subject that can be understood and learned. And so getting that kind of faith and confidence from the 7 institutional LPs was a massive kind of learning journey in terms of relationship building and in terms of demonstration of core capability, which I'm kind of now looking to put to Fund 2. I think one of the other key learnings is that the innovation in the UK in technology is absolutely fantastic. And there is a huge amount of really exciting entrepreneurs making massive progress in really kind of leapfrogging the decarbonisation pathways. And so you have to be really careful in terms of looking at technology and knowing whether that's going to be leapfrogged by something even better in 12 or 18 months' time. It's a very rapidly fast-moving space. And so to be completely connected into the innovation and the progress that's being made in innovation is really, really critical to operating in the space. So there are a few thoughts.
Ultimately, I guess as asset managers, our role is to take the people who've given us the money and put them into useful investments. And when we look at Europe, at KKR in particular, our investor base is very wide, right? So we've got Middle East investors, we've got investors from Asia, we've got investors from the US, and each of them are on different stages or different priorities in terms of their sustainability journey. So it's really important for us to educate, and for every investment, what is our roadmap and value creation journey for that particular company to the different audience we have, right? So in Europe in particular, it's very ahead with its thinking. The regulation standards are here, the exit opportunity is very clear, and the transparency is increasing. But if we look to other regions, particularly in Asia or in the Middle East, there's a different kind of lens to it. So it's important for us, and quite a challenge as well, is when this topic gets higher and higher up the agenda, that we're able to really clearly say this is our value creation journey for this company, and map it to their particular objectives or criteria. So I think it's important to have that global lens. Ultimately we're pooling capital from everywhere in the world and making Europe an attractive place to invest. So we need to be able to communicate that message back to our investors, what's going on here. So it's not just UK, it's Europe, globally as well.
Yeah, I think for us it's always been, from the start the purpose has been to invest to solve global challenges, so we've always had that thematic focus, but we've also, through our first 2 funds, really had to prove the concept that we also were able to deliver returns, and not because of the thematic focus, or not despite the thematic focus, but rather because of the thematic focus. And I think that's what we've done successfully. And if we look at the Preqin benchmark, we come up in the top percentage in terms of returns, and I think that is just fundamental given where we are in the world right now with geopolitical tension, inflation, everything that's going on. To have this lens it really makes business sense. It's not something that is nice to have or should be necessarily driven by regulation, but it's something that you as a business owner of businesses and a CEO need to take into account. So I think that's super important. What is challenging is still that it depends whether it's. I think we went from 10 years ago where sustainability was very expensive to 5 years ago when everyone was making money out of it. And I think the truth lies somewhere in between. That it depends on what measures you put in place, what actions you're taking. And I think it's really important to figure that out to make the right choices. So I think the challenge going forward will be to really identify those opportunities, because I know there are a lot of opportunities.
I won't add too much because I think that's all a lot of great challenges already. But I think one of the key issues is really communicating to stakeholders about what you're doing and what impact it's actually having, because there's so much of this process that relies on being able to, for example, if you're a smaller fund, being able to communicate to asset owners, what you're doing and why it's important versus others. Similarly, asset owners need to be able to understand what they're investing in, and that kind of flow is also really hampered by the fact that we've got a really kind of technical, science-based, what I'll say is like probably one of the most accurate basis of scientific research ever is climate science. It's really shown to be like very accurate in terms of what's been predicted versus what's happened, but it's very complex, it's really hard to understand. And so I think, that issue of communication, like we're in a world right now where there's a million different metrics to measure things. It's hard for people to have the time and the resource to fully comprehend what they all are. So I think keeping things simple is probably one of the bigger challenges that there is for implementation.
So I think that the biggest challenge that we see and we face is trying to make sure that our clients understand the importance of good data in the first place and the effort that it's worth doing something well first time rather than just trying to iteratively improve over a period of time. And when we're doing this, we obviously do assurance as well, so we look at it through an assurance lens. But what we would like to be able to do is make sure that all of our clients could get to the same level of achievement in terms of having good baselines. If you have a faulty baseline, you've compromised your decarbonisation pathway before you have even really got underway. So getting those foundations in place is one of the biggest challenges that we face. And those challenges also relate to where people are on the journey, what type of investments they have. So somebody who, for example, has a portfolio of distressed assets in an emerging market will have other bigger fish to fry than simply just trying to get to a good baseline. They will move at a different pace to somebody who's got data infrastructure in Europe, in private assets. This is where something like the private markets decarbonisation pathway roadmap becomes more valuable. But it's trying to get people to this point where they're comfortable, they've got some really good positions from which they can execute and understand what they need to do. That's, for us, the challenge.
Thanks, guys. One point across the piece here for me, and question from my perspective, really, but with traditional finance, there's that balance between risk and reward, but with sustainable finance and the approaches you've talked about, how do you guys look at that balance between impact and that long-term return? Perhaps Hugo.
So, as a non-investment part of this panel, I look at this from the point of view, if we're trying to encourage a position where people can be delivering something that is really, really solid, the only way in which I think that can be properly achieved is by focusing on, again, what they know, where their expertise lies, what they can actually be doing. Because if we kind of deviate from that, everything starts to become very disparate. And if it becomes disparate, we don't really get to the end point that we need. I also think that just to the point of what the value is, and this has been touched on before, when we look at what are the opportunities versus the risks in these things, we're starting to see more emerging information from deal flow on what that positive value is. Some people suggesting a 1.2x on EV on exit for really good ESG performance. That's helping to highlight the positives that sit around the opportunities rather than this purely being a risk-based environment and a risk-based approach.
Interesting. Thank you. As I've just been given our 5-minute warning, I'll try and find a way to sum all this information up. I think before I open this up for questions for you guys as well, I've been frantically making notes, as I'm sure quite a few of you have as well, but there's said a lot to take in across the board, but I think some of the key pieces in terms of key takeaways in a summary for all of us, it seems education and engagement is kind of a baseline barometer for where we need to get to help drive this forwards for decarbonisation. Materiality has come up a few times, and again, something that everyone in sustainability needs to be aware of as to how to understand that baseline and form the foundations for data as well. That's specificity for roadmaps, particular investments, choices for countries, products, services, and so on is paramount. Communication, good governance, and I think something that's sort of reading between the lines, patience to make sure we get this right. So, it's been mentioned not to rush things and push things forwards too quickly and make them iterative, but you build those foundations using all those particular items and activities to get things right, form that level playing field and go forwards from there. But as I said, we've got a couple of minutes, but guys, just to give a quick summary, is there anything to add to that? And as a quick short one word or short answer, what are you most looking forward to in this space and what are you seeing or excited about seeing?
I must add the opportunities angle to this because I think there's a lot of focus on risk and rewards, and I think the regulations that we see now put in place, they're disclosure regulations, right? But they're put in there to be able to tax and do things with the data. It's not going to end there, I think, and I'm hopeful for that. When that time comes, then our companies will be very well prepared for higher costs on carbon.
Great stuff, Emma. Ella?
I'd say breakthroughs is probably what I'm most excited for. We obviously have quite a lot of the tech that we need at scale, but also it's one of the most rapidly evolving spaces of innovation, and I'm excited to see, what disruptors come out of that innovation.
Beverley?
The waterfall of institutional investment money into specialist fund managers so we can decarbonise the hard-to-abate sectors, so there's technology breakthroughs that we so desperately need.
Thank you. Stanley?
I'm just excited if everyone gets more interested in this topic and I can talk to anyone on the street about it.
Nice. Hugo, let's wrap it up.
So I'm very excited about more data, great data, having a data playing field that allows us to get great baselines to manage our way to decarbonise world.
Lovely. Thank you, guys. Well, thank you very much. It's been a pleasure to host this and listen to you all and all the insight. But guys, in the audience, are there any questions from yourselves before we wrap up? And hopefully we can get a mic over somehow. Or not? You get a...
Take mine.
Fair enough. Right. I'll do this the old-fashioned way and come and hand you my mic. There you are, sir.
Thank you, Charlie. I'm Anthony Alvarez. I am part of a company that does plastic to fuel. We are a Mexican startup, and I wanted to ask, given the seniority of experience in finance, one of our biggest challenges is that when we bring solutions like ours that tackle plastic pollution, which has a carbon footprint, even if you have it rotting away in a landfill, that produces effects. And to us, it's very clear. But we have a lot of the more traditional finance offices we approach tell us, well, you've already got electric vehicles. Fuels are probably liquid fuels, even if they are synthetic and non-fossil, are probably going to be phased out. And what I face is that the best solution, ideally, sometimes seems to stand in the way of a good solution that can be implemented to at least improve. So how can clean techs go past this against the arguments that are given of ideal solutions instead of focusing on just getting better today? Thank you.
Thank you. So that seems to be, in short, don't let perfect get in the way of good, perhaps. But does anyone want to have a stab at that one?
I'm happy to give it a go. So I think the key thing you need to start in your pitch is what the market need is. And therefore, who are the end users that are going to be using the fuel from plastic? Clearly not cars, but ships, for example, could be a target market that is big enough, right, that the investor will then be interested in the proposition. And once you've kind of outlined the need, you need to do that in a quantitative way, okay? So you need to be able to show the size of the market. You need to be able to show that you've engaged with 3 or 4 players in the market in a meaningful way commercially, right? And then you need to demonstrate how your technology meets the need in a really tangible way, 3 or 4 key points. And then you can build the rest of the pitch from that. But fundamentally, you've got to really do a lot of work in the market, talk to the particular end user that you're interested in, and show why they have to have your solution, why it's 10 times better than anything else out there.
Thanks, Beverley. We've got 1 minute left if there's any other questions in the audience. Beverley, sorry. Right, I'll come on over.
So, Aaron Kelshka, just a question with respect to pension funds and obviously them embracing internationally the concept of universal ownership, the idea that the investments are large enough that they will have a material impact. In effect, pension funds are buying a slice of the economy. How are you sort of engaging with pension funds to try and get them to embrace that to the extent that they can meaningfully allocate into innovative vehicles, including benefit finance, obviously venture capital and the like? Thanks.
Thanks, Aaron. Who wants to tackle that one?
I mean, we have pension funds as our investors, and I think a lot of it was going into proving that those first 2 funds, that we actually were able to deliver market rate returns and a little bit beyond that as well with our thematic approach. So I think returns are really key to get actually the pension funds behind it. As I said before, I used to work for an insurance company. There we did blended finance together with the SIDA, the Swedish Development Agency. Those are also things that pension funds can do. So I think it's all about, trying to understand, what your role is. It can be engagement with companies. It could be engaging with, through vehicles like blended finance, but it can also be, looking for private equity, if you have such a portfolio that is able to deliver what you need in terms of returns and also tangible impact.
Thanks, Emily. Well, guys, thank you very much. We're slightly over, so appreciate the time and thank you very much to our panel for a really insightful hour.